Welcome to vTalkInsight, Risk Sentiment Daily for December 16th, 2025. After an AI-driven wobble in equities, safe haven metals near record highs, and a week packed with central bank meetings and jobs data, markets are heading into a pivotal, late-cycle stretch. Let us unpack how that mix is shaping risk appetite across assets today. Across markets, risk sentiment sits firmly in late-cycle territory, cautious, but not yet capitulating into full risk-off mode. Major U.S. equity indices have slipped from recent highs and volatility is back in the mid-teens, signaling investors are trimming exposure at the margin rather than rushing for the exits. That aligns with a macro backdrop where growth is still holding up, yet the cushion against negative surprises is getting thinner. Cross-asset signals underline this mixed picture. Gold and silver are pressing toward all-time highs on persistent demand for safety and concerns over policy uncertainty, while high-quality bonds yield levels not seen since the late 2000s and are again viewed as credible portfolio hedges when equities decline. At the same time, industrials are breaking out, equal weight indices are making new highs, and financials have recently outpaced large-cap tech, all of which point to a still functioning appetite for cyclical risk. What keeps sentiment cautious is the density of event risk layered onto stretched valuations. Investors are staring at closely balanced decisions from the European Central Bank, Bank of England, and Bank of Japan, plus a delayed U.S. jobs report where data quality has been questioned and the range of possible labor outcomes is unusually wide. Compared with last week's more straightforward, liquidity-driven optimism, today's tone is more two-sided, with inflation, labor, and AI valuations all capable of shifting the narrative quickly. A key bearish driver is sticky inflation and an intensifying affordability squeeze on households. Despite progress on some headline measures, service sector inflation remains stubborn, particularly in areas such as elder care and child care where labor shortages and rising wage bills keep costs elevated. Tariff-related pressures have not fully passed through, and there are concerns that record tax refunds in March and April could actually reinforce price stickiness if extra cash fuels further opportunistic price hikes, especially in services. For households, the pressure is increasingly visible. Persistent high prices for essentials like food, fuel, housing, and healthcare mean affordability now ranks as the top concern for many Americans, with roughly half reportedly living paycheck to paycheck and a third unable to cover a $5,000 medical expense. Survey data show 41% of people plan to cut back on holiday spending, and nearly 7 in 10 perceive gift prices as higher than last year, underscoring how inflation fatigue is feeding into weaker consumer sentiment. This combination complicates the disinflation and soft landing narrative. On one side, officials such as the New York Fed president still project inflation drifting below 2.5% next year, with tariff effects seen as largely one-off and services and housing expected to cool over time. On the other, persistent affordability stress and stagflation-style worries raise the risk that consumption slows before price pressures fully fade, pressuring retailers' margins and leaving central banks wary of over-delivering on rate cuts. Markets are watching upcoming inflation releases and consumer data closely because any upside surprise on prices against this fragile backdrop could hit risk assets hard. The second major headwind is growing concern that labor market softening could tip the cycle toward recession risk. Recent payroll reports and real-time indicators suggest employment growth is stagnating, with some analysts warning that combined October and November data could even show net job losses. Upcoming non-farm payrolls are expected to be weak, with some forecasts pointing to gains of only a few tens of thousands, or even a contraction of around 60,000 jobs, dragged down by government layoffs. Complicating matters, the quality of the data is itself in question. Government shutdown disruptions and significant understaffing at the Bureau of Labor Statistics have raised doubts about the reliability of both the household survey and the unemployment rate, pushing investors to lean more on payrolls and private indicators to gauge momentum. That uncertainty widens the range of scenarios markets have to price, from a mild soft patch consistent with a soft landing to the early stages of a more material downturn. Rate expectations and risk premia hinge heavily on how this labor story evolves. Bond markets currently assign only modest odds to an immediate Fed cut, but many participants argue that unemployment moving decisively above 4.5% could accelerate expectations for earlier and deeper easing. At the same time, strategists warn that if jobs data rebound sharply instead, the narrative could quickly flip back toward renewed hikes, undermining today's rate cut optimism and hurting risk assets. For credit and cyclicals, that means higher sensitivity to each incremental labor print, with restructuring activity already rising in Europe and private credit managers gearing up for more distressed situations into 2026. A third bearish force comes from AI and valuation bubble concerns, particularly in U.S. technology. Several indicators now resemble classic late-stage exuberance. AI-related stocks trade at extreme multiples, public equity ownership in tech is at record highs, and tech investment as a share of GDP has surpassed levels seen around the 2000 peak. At the same time, some of the largest AI investors are actually underperforming the broader S&P 500, suggesting that heavy capital spending is no longer being rewarded unconditionally. Under the surface, questions about sustainability and funding are multiplying. Investors are rotating out of the most expensive AI names and into banks and value sectors, reflecting skepticism over whether current infrastructure spending and earnings growth can be maintained without stronger macro support. Concerns are also emerging about balance sheet strength, as aggressive AI buildouts increase leverage and raise the risk of absorption issues for both equity and credit holders. In private markets, soaring valuations for firms like SpaceX and a widening disconnect between private and public pricing are limiting IPO exits and reinforcing the sense of froth. The implication is not necessarily an imminent collapse in AI, but a more fragile and dispersed regime. Market conviction in the AI trade is clearly less stable, with narratives flipping quickly on each earnings report or guidance change, and investors demanding clearer evidence of monetization and sustainable free cash flow. That raises event risk around AI-heavy companies, where even small disappointments on margins, capex discipline, or demand can trigger outsized moves. The key watch points are coming quarters earnings, credit developments in AI-exposed borrowers, and whether private valuations adjust down toward public markets or instead keep stretching the rubber band tighter. Balancing those headwinds, a powerful bullish driver remains easing policy and fiscal support. The Federal Reserve has already delivered a substantial cutting cycle, with cumulative reductions well over 100 basis points, and markets still price scope for further easing as long as inflation cooperates. Short-dated yields reflect expectations for potential cuts as early as January, and the steepening yield curve points to investors anticipating a shift from restrictive toward more neutral policy over time. In the UK, the Bank of England is expected to cut rates soon and again next year, while the European Central Bank is broadly seen on hold for years rather than pivoting back to hikes. Fiscal policy adds another layer of support. Upcoming U.S. tax changes, including larger refunds, reduced withholding, and additional benefits around state and local deductions and overtime or tips, are expected to lift disposable income next year and into 2026. Analysts see that as a potential offset to today's affordability concerns, providing a delayed but meaningful tailwind to consumption and corporate revenues. Forecasts from institutions such as the New York Fed point to stronger growth next year, and some strategists expect a U-shaped recovery where fiscal stimulus and improving jobs data drive faster expansion in the second half of 2026. For markets, this combination of easing and fiscal expansion creates a backdrop that still looks broadly supportive for risk assets over the medium term. One narrative gaining traction is that a mix of monetary easing, expansionary fiscal policy, and moderating inflation could favor equities and selected emerging markets relative to cash and low-yielding bonds. However, that constructive view is conditional. If inflation proves stickier than central banks expect, or if labor data rebound too forcefully, policymakers may be forced into a more hawkish stance that challenges current rate cut pricing. Watching the tone from this week's meetings at the ECB, Bank of England, and Bank of Japan will be crucial for gauging how durable the easing bias really is. Despite valuation worries, AI and tech demand resilience stands out as an important bullish counterweight. Corporate surveys show that more than two-thirds of CEOs plan to increase AI spending by 2026, even though most do not expect quick profitability from these investments. In semiconductors, companies such as NVIDIA continue to face overwhelming demand for AI chips, with supply constraints driven by manufacturing and assembly complexity rather than weak end markets. NVIDIA has even removed China from base case forecasts, meaning any sales into that market now register as upside rather than a source of downside risk. Importantly, AI adoption is broadening beyond the original mega-cap winners. Consumer discretionary companies are using AI to support revenue growth and cost control, while industrials and infrastructure suppliers benefit from multi-year data center and power grid investment linked to AI workloads. Recent strength in metals such as copper, alongside improving order books for equipment and industrial names, reflects expectations of tighter supply and ongoing capex demand rather than a collapse in the AI thesis. Even after recent pullbacks, major AI-related stocks have rebounded, suggesting dips continue to find buyers rather than sparking a wholesale exit. The net message is that AI remains a powerful, long-term growth theme even as markets debate the right price to pay for it. Valuation and bubble concerns bias the risk toward higher volatility and greater dispersion, but the underlying demand picture, from chips through software to real economy applications, still looks strong. For portfolios, that argues for close attention to which companies are demonstrating real monetization, capital discipline, and manageable leverage instead of relying on the AI label alone. Upcoming earnings seasons, capex guidance, and evidence of AI-driven margin improvement outside the tech sector will be critical in determining whether resilience can translate into sustained performance. The final supportive driver is broadening market breadth and rotation across regions and sectors. Market breadth has improved notably, with industrials breaking out and the equal weight index hitting a 52-week high, signaling that leadership is no longer confined to a handful of mega-cap tech names. Financial stocks, as captured by major bank indices, have outperformed technology since early December, reflecting shifting expectations for Fed policy and a tentative vote of confidence in economic recovery. Deal activity is also robust, with global transaction volumes up around 40% year-to-date, pointing to healthy corporate confidence and liquidity in capital markets. Outside the U.S., flows and fundamentals are also broadening the opportunity set. Emerging market equities and debt have benefited from expectations of a weaker dollar, which eases the burden of dollar-denominated liabilities and supports local fundamentals. Frontier markets such as Egypt, Nigeria, Ghana, and Kenya are drawing significant interest thanks to fiscal consolidation, better transparency, and more market-oriented reforms that support local fixed income and currencies. Earnings revisions are turning positive in both developed and emerging markets outside the U.S., suggesting potential convergence in sector and regional performance. This broadening helps reduce concentration risk and offers more diversified drivers of return, but it is not without its own vulnerabilities. Emerging market currencies have already posted strong gains this year, and with valuations richer and carry buffers compressed, future returns may be more modest and volatile, particularly if the dollar stages even a moderate rebound by 2026. Persistent weakness in China's domestic economy, from retail sales to property, also threatens some of the more cyclical, China-linked trades that have benefited from stronger commodities and pro-cyclical positioning. Investors are therefore watching the relative performance of equal weight versus cap weight indices, EM foreign exchange, and financials versus mega-cap tech, as important gauges of how durable this rotation really is. To sum up, risk sentiment is late cycle and cautious, caught between sticky inflation and a strained consumer on one side and powerful supports from policy easing, AI demand, and broadening market breadth on the other. How central banks navigate this week's decisions, how the next round of labor and inflation data land, and whether AI earnings can justify current expectations will go a long way toward deciding whether markets stay in a choppy, range-bound regime or move into a more decisive trend. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.